Welcome back. We will review some terms that I want to make sure we have a common understanding of. There will also be a short paper that will be on a topic that you have a good understanding of already without having to read anything new. The terms that we're going to go over may have different meanings in different contexts. Some may even have slightly different meanings in the different units that we are going to be going through, so let's all start out on the same page with a common understanding of these terms for the purposes of this course. The terms are risk and hazard, insurance and insurable risk, private insurance versus government insurance, individual insurance versus group insurance, life and health insurance, insurance agent versus insurance broker, insurance company and different structures such as stock, mutual, and reciprocal, disability insurance, and finally, underwriting. Pure risk has two sides of the tail, loss and win. The stock market is a classic example of the same idea of variation in outcomes, but with profits as well as loss being outcomes. We'll focus most of our attention on the downside of risk in this class, which is the chance of loss. The actuaries and financial analysts define risk as the variation of loss about an expected mean. This can include standard deviations and normal curves. The interesting thing about life and health insurance is that individuals can and will do things that reduce or increase their chance of loss, but that chance of loss still follows a random pattern. Let's look at your health, for example. Most of us wake up every morning expecting to be healthy, but you may have an unexpected heart attack. You may even have a lifestyle that might make that heart attack more or less likely based on your diet, exercise, and whether or not you smoke. All of these things can impact the chance that you'll have that heart attack. But that heart attack is still going to be an unpredictable and random event when it happens. When a health or life insurance company looks at a pool of 100,000 insureds, they can start to get some predictability in how many of us will have that heart attack this year. And through that statistical analysis, they are able to reduce the risk to their company from its impact. For you as an individual, that risk and the personal and financial impact of the heart attack is very large if it were to happen. The same risk, the very same risk, looks much different depending on your viewpoint, and that is the magic of insurance. What is a catastrophic risk for an individual becomes a very manageable event for an insurance company. Let's then say that risk at its simplest form is the chance of an event that causes personal and financial loss. Insurance cannot undo the personal loss, but it can and does provide funds for the financial loss. A hazard is something that increases the chance of an event that leads to financial loss. We will need to understand why this is important to insurance companies and underwriters. And this is a very large issue with the health reform debate and helps to frame the mandatory insurance provision in the Health Reform Act. A physical hazard is the first kind of hazard. It is anything that makes it more likely that an individual will have a loss. Our lifestyle choices are the best example. If I eat at a fast food restaurant every day and supersize each meal, do not exercise, then I will likely become overweight, perhaps get diabetes, and increase the chance that I will have an expensive illness or die at an early age. In auto insurance, this would be similar to driving with bad brakes and bald tires, which is an accident waiting to happen. The other two hazards are often mistaken for each other, but there is a very real distinction between the two. Moral hazard means doing something for the sole purpose of collecting the insurance proceeds, often in an illegal manner. This is the businessman who sets fire to his warehouse in order to collect the insurance, or the wife who kills her husband to collect the life insurance proceeds. Thank goodness this kind of thing does not happen very often, but it is a very real potential that the underwriters have to worry about. A few years ago, there was a story in the paper about two old ladies who were arrested and charged with insurance fraud and murder. They were seemingly kind old widows who took in boarders. Homeless men befriended them, took out life insurance on them, and then killed them to collect the life insurance proceeds. Better be careful about your roommates. The last type of hazard is morale hazard. Different from moral hazard, this is morale hazard. This is not illegal, but more about your attitude and choices that you make differently because you have insurance. Morale hazard is when you are not as careful about things because the insurance company will pay for anything bad that happens. In health insurance, one form of this leads to excessive care and tests since the insurance company pays the bill, so the more the better. Another form of it is engaging in risky behavior because you know that the health insurance company or life insurance company will pay for any negative consequences. Most people will not engage in moral or morale hazard, but the fact that some will has a real impact on the insurance mechanism. The classic definition of insurance is the pooling of fortuitous losses by transfer of risk to insurers who agree to indemnify insureds for such losses. The pooling of losses means that the insurance company insures a lot of people, most of whom do not have losses. Everyone pays for the losses of the few. The law of large numbers means that the more people that are insured, the more predictable their losses become. This impacts the price of insurance, usually lowering it because it lowers the variation in loss or risk for the insurance company. Fortuitous losses means that the losses are unplanned by the person who is insured. They are a matter of luck, bad luck. Risk transfer means that the insured contractually transfers the financial impact of the event to the insurance company. The insurance company agrees to make the insured whole after their event, thereby indemnifying her for the financial consequences of the loss. The principle of indemnity means that if I am in a car accident and have a 5-day hospital stay which results in a hospital bill of $20,000, the insurance company does not pay me $25,000. I do not get to profit from the event. They only pay me $20,000 to put me back in the financial position I was in before the event. From the definition of insurance, we can easily move to the requirements of an insurable loss. There needs to be a large number of exposure units, a large number of insured lives, for example, for the actuaries to be able to do their calculations. The loss needs to be fortuitous, accidental, and not in the control of the insured. You need to be able to tell that there was a loss and it must be measurable. Without this, the math of predictability for the insurance company breaks down. The loss also cannot be catastrophic in nature, such as a war, where one event is so severe that it would bankrupt all of the insurance companies. And the math needs to work for the insurance company to be able to calculate premiums that are reasonable and the public is willing to pay for. If it does not meet these requirements, that is when the marketplace breaks down and the government steps in. What is an insurable risk? Life insurance is, in that there are a large number of lives. Death is usually accidental and not intentional. You can determine when death occurs. And due to the law of large numbers, the amount of deaths across a large number of people follows a predictable pattern that is not catastrophic. The math works, and the premiums that are reasonable can be calculated. So what is not an insurable loss? How about unemployment insurance? Very timely issue to think about right now. There are a large number of exposure units. Every person in the United States who works and every company and organization that has employees is in that insured base. Is it accidental? Not always. And in fact, unemployment usually is not accidental. So that's problem number one. Now, you can determine when it happens and you can measure it. Can it be catastrophic? I think the events of the last 2 years have reinforced the fact that in a recession it is catastrophic and that a large number of people are currently out of work all at once. And it is this catastrophic nature of unemployment insurance that causes a break with the rules of an insurable risk. That's really why it is run by the government. It's run by the state government, often with federal funding. Other examples of uninsurable risks are terrorism, war, and retirement. A heart attack or stroke, by comparison, is an insurable risk. Since there are many exposure units, which are people, the event is accidental and unintentional. Even if your lifestyle increases your odds for it, no one tries to have a stroke or a heart attack. You can determine the event and measure the economic impact of it. And since it happens to one person at a time, it cannot be catastrophic, and the chance of loss can be calculated. Arguably, the premium is economically feasible. Adverse selection is a topic that we will discuss in many of our units, and it is always in the insurance equation. In adverse selection, those who are more likely than average to need the insurance will buy it. Those who are healthy and unlikely to be sick tend not to buy as much health insurance, and those who are sick and likely to most use health insurance want to buy a lot of it. This causes problems for the insurance companies if they base their rates on the health of the average person. So healthy people will see that premium as too high, and sick people will see it as a bargain. This is the dynamic that the Health Reform Act was trying to address by mandating that everyone buy insurance. In effect, the healthy will subsidize the sick. We need to keep in mind that insurance is all about the many paying for the losses of the few, but that does not mean that everyone pays the same price. Some would say this is a breakdown in the insurance mechanism for health insurance, and is why there should be a single payer system or nationalized health care. Others suggest that the insurance mechanism can be efficient in helping people make healthy choices by making them face the financial consequences of unhealthy choices through higher premiums, deductibles, and copays. This is a very complicated issue, and I look forward to hearing your thoughts on it in one of your papers. The private versus government insurance split often follows the definition of an insurable risk. Risks that meet the definition are most often, though not always, insured through private insurance companies. Examples are life insurance, historically health insurance for most of us, and such things as auto insurance and homeowners insurance. When a risk does not meet one or more of these tests of an insurable risk, then the government steps in and either provides insurance, often at subsidized or even free rates, such as in the case with Medicare and Medicaid, unemployment insurance, or the National Flood Insurance Program. Another possibility is that the government can step in and grant funds or low-interest loans even in the absence of insurance, such as when FEMA steps into a federally declared disaster area. Now, some would say this is the worst in adverse selection, because people in certain flood-prone areas do not buy flood insurance because they have been conditioned to think that the government is going to bail them out anyway. So why pay those high premiums? Is this kind of thinking clouding the health reform debate? Perhaps the retirement and Social Security funding debate as well? Individual insurance is when you buy a life insurance policy from your friendly NML or American Family agent. You are the consumer. You choose what exactly you want to buy, who to buy it from, and you pay the whole premium. Group insurance, by contrast, is provided through an employer. Your employer chooses the insurance provider and typically makes choices about coverages and options for you. The benefit is that you get cheaper group rates, and often the employer pays some or all of the premium. Health, dental, and disability insurance are often provided in group programs along with a limited amount of life insurance. Life and health insurance is all about medical insurance, dental, disability, and of course, insuring your death. It is in contrast to what is called property and casualty insurance, which deals with insuring such things as your auto, home, and apartment. Insurance agents and insurance brokers both appear to be salespeople who are trying to sell you insurance. There's a very fine, but at times very important distinction between those two, in that insurance agents are agents of the insurance company and are working for the insurance company and not you, the consumer, in theory. Insurance brokers, by contrast, work just for their clients, you, the consumer, and only have the incentive to negotiate the best deal for you, again, in theory. Brokers are also often paid differently, directly by their client in the form of a fee rather than by commission from the insurance company. In practice, there are many very good insurance agents who truly put their clients' needs first and always provide appropriate advice, and there are some brokers who do not do a very good job serving their clients' needs. You need to keep in mind, however, that the insurance agent is being paid by the insurance company and may at times be conflicted between the company's interest and yours. Insurance companies are very different animals than most companies. Like other financial service companies, their financial statements have unique characteristics, and they are heavily regulated at the state level by departments of insurance. Here in Wisconsin, the Department of Insurance is called the Office of the Commissioner of Insurance, or the OCI. Sounds like a TV show. But trust me, it's not a very exciting place. Insurance companies, similar to banks, can be stock companies or mutual companies. Stock companies have owners, the stockholders, who elect the board of directors. Stock companies are going to be focused on being profitable with dividends paid to the stockholders. Mutual companies, by contrast, are owned in theory by their policyholders who elect a board of directors. In practice, very few policyholders vote, so the board and management really run the company. Dividends can be paid to policyholders either directly as dividends or through reduced premiums. In practice, policyholders are not demanding dividends for the most part, and really they are used to keep the premiums competitive with other insurance companies. Due to their structure, most mutual insurance companies do not have to be focused on quarterly earnings, and often mutuals will tout this as their ability to do what is best for the long run rather than what is best to make their results look good for the quarter. At the same time, mutuals may have a perceived lower cost of capital due to their structure, which also results in lower premiums or can result in lower premiums. Reciprocals are similar to mutuals but are managed by an attorney in fact and may be assessable. Being assessable means that if there are more losses than they planned on, they can come back to you, the policyholder, and ask for more money. Certainly individuals, but also businesses, should be very careful buying assessable policies. Both mutual and stock companies write disability insurance, which may be more needed than life insurance, but is probably the most ignored insurance product. I am much more likely to be injured tomorrow and be out of work for 6 to 12 months than I am to die early. Disability insurance is income replacement insurance while you are disabled and unable to work. No matter what line of insurance we are talking about, underwriters get a bad name. When you seek to buy insurance from a company, the underwriting process, and in some cases an actual individual underwriter, decides whether or not to accept your application and issue a quote, and if so, at what price. The underwriter practices discrimination, and the state allows it as long as it is not unfairly discriminatory. Unfair discrimination would be based on race or nationality, for example. Fair versus unfair discrimination is at times defined in statute, but generally is meant to mean that underwriters can only discriminate in areas that are valid predictors of increased hazard. A smoker, for example, increases the hazard of illness or death, and in most cases is seen as a valid point of discrimination and charging a higher rate. Illegal drug use is another example of a risk factor that can impact your insurability. Now, for your first paper, I would like you to discuss your personal risk management assessment. This is a pretty wide open topic, and you do not have to cite any sources, though you can if you choose to. This paper should be at a maximum 2 pages long, and I would like you to think about the risks in your life, identify them, discuss them, and evaluate what, if anything, you have done to manage these risks. Each person may have a very different paper based on what they see as important in their lives and their individual situations. Potential topics to touch upon are your work-life balance. Are you happy with life, your career? Retirement planning is a huge issue for most people and is very appropriate for this paper, though it is not mandatory. For myself, raising and providing for my 4 children and then retirement for my wife and myself are among the big areas of potential risk and necessary planning that we face. Although with 4 children, I may never retire. Many of us have come to realize over the last 2 years that our employment situations have more risk than we thought due to the economic downturn. If you have any questions about what is appropriate for this assignment, please call or email me. That brings our first unit to an end, and I look forward to working with you in the second unit.